Most Americans think the biggest threats to the economy are easy to spot. Inflation dominates headlines. Politicians argue about rising prices. Every few months, social media fills with predictions of a stock market crash. Yet, some of the forces shaping your financial future rarely make the news at all. One of the biggest stories in global finance is unfolding thousands of miles away from Washington and Wall Street. It is happening in a country many Americans associate with technology, anime, and tourism, rather than the future of the U.S. economy. That country is Japan. At first glance, Japan's financial system may seem irrelevant to the average American family. Most people focus on mortgage payments, credit card debt, retirement accounts, and everyday expenses. But for decades, Japan has quietly influenced all of those things, in ways most people never realized. To understand why, we need to go back more than 30 years. During the 1980s, Japan experienced one of the largest financial bubbles in modern history. Real estate prices exploded, stocks surged higher year after year. Many investors believed Japanese assets would continue rising forever. Then, the bubble burst. Property values collapsed, stock markets crashed. Economic growth slowed sharply. What followed became known as Japan's lost decades. Unlike most recessions, Japan's slowdown lasted for years. Inflation disappeared, wage growth remained weak. Consumer spending slowed, and the economy never fully regained its former momentum. Facing this challenge, Japan's central bank adopted policies that seemed extreme at the time. Interest rates were pushed lower and lower, until they were near zero. Eventually, some rates even became negative. The idea was simple. If borrowing money became cheap enough, businesses and consumers would spend more and help restart growth. But there was an unexpected consequence. When interest rates stay near zero for years, investors face a problem. Savings accounts and government bonds produce almost no return. Pension funds, insurance companies, and major financial institutions still need profits. But their domestic options become less attractive, so they started looking elsewhere. They found opportunity in the United States. American Treasury bonds offered higher yields. Corporate bonds offered higher yields compared to Japan. Many U.S. investments looked far more appealing. As a result, huge amounts of Japanese capital began flowing overseas. Over time, Japanese institutions became major buyers of U.S. government debt and important players in global financial markets. Most people never noticed it happening. There were no dramatic headlines explaining how Japanese savings were helping support global liquidity. Yet, year after year, the system kept running quietly in the background. And as more money left Japan, investors discovered something else. If borrowing costs in Japan were extremely low, why not borrow money there and invest it where returns were higher? That simple idea evolved into one of the most influential trades in modern finance. For years, it worked remarkably well. It became deeply woven into global markets and helped fuel an era of abundant liquidity that many investors came to take for granted. The problem is that systems built on assumptions can appear stable, right up until those assumptions change. And after decades of near-zero interest rates, the foundation supporting this entire arrangement has started to shift. That shift could eventually affect Treasury yields, mortgage rates, stock valuations, and the overall cost of money across the economy. And that's where this story becomes far more important than most people realize. For decades, the strategy seemed almost effortless. Investors could borrow money in Japan at extremely low interest rates, convert it into dollars, and invest in assets offering higher returns. As long as those returns stayed above borrowing costs, the trade remained profitable. This became known as the yen carry trade. It may sound like a strategy used only by professional investors, but its effects reached far beyond trading desks. When trillions of dollars search for higher returns, that money doesn't stay in one place. It flows everywhere. It moves into government bonds, corporate debt, real estate, stock markets, and countless other investments. Over time, this steady stream of capital became one of the hidden sources of liquidity supporting global markets. Liquidity is simply the ease with which money moves through the financial system. When liquidity is abundant, borrowing becomes easier, investments become more attractive, and asset prices often rise. When liquidity tightens, the opposite tends to happen. For years, global markets benefited from a world where Japanese money remained exceptionally cheap. But every trend eventually changes. In recent years, Japan began experiencing something it had struggled to achieve for decades: inflation. Prices started rising, wages improved, and economic conditions shifted enough that policymakers could no longer justify keeping rates near zero forever. As a result, Japan's central bank began moving away from the policies that had defined its economy for a generation. Interest rates started rising. That may not sound dramatic, but the implications reach far beyond Japan. As borrowing costs increase, the carry trade becomes less attractive. Investors who once borrowed cheaply to buy foreign assets suddenly find the profits shrinking. And when the economics of a trade change, money often moves with it. Some investors reduce positions, others take profits, some move capital back to Japan, a process known as repatriation. This matters because Japan has long been one of the largest buyers of U.S. Treasury bonds, and Treasury yields are heavily influenced by supply and demand. Many people assume the Federal Reserve controls all interest rates. It doesn't. While the Fed strongly influences short-term rates, long-term yields are largely determined by market forces. If demand for Treasury bonds weakens, while the U.S. government continues issuing large amounts of debt, yields may need to rise to attract buyers, and those yields affect far more than government borrowing. They influence mortgage rates, corporate borrowing costs, stock valuations, and nearly every corner of the financial system. This helps explain why many Americans remain confused by today's economy. They hear talk of possible rate cuts, yet borrowing still feels expensive. Mortgage rates remain high, housing affordability remains strained, and financial conditions often feel tighter than expected. Part of the reason may lie beyond Washington. If fewer investors are willing to buy long-term Treasury debt, yields can stay elevated, even when policymakers would prefer lower rates. The effects spread quickly. Higher yields raise borrowing costs for businesses, making expansion and investment more expensive. Investors also place lower valuations on future earnings when interest rates are higher. The housing market faces similar pressure. Higher mortgage rates reduce affordability, causing buyers to wait and homeowners to hold on to older, lower-rate loans. All of these effects point to the same reality. The price of money matters. For many years, the global economy benefited from unusually cheap money. That environment is now changing. This doesn't guarantee a crisis. Markets adapt, new buyers emerge, and economies adjust. But it does mean investors should pay attention to developments that rarely dominate headlines. The biggest financial stories are often the quiet ones. Most people focus on political drama, celebrity CEOs, or whatever dominates the news that week. Yet some of the most important forces shaping the future operate slowly and almost invisibly. Japan's changing role in global finance is one of those forces, because the greatest risks are rarely the ones everyone is talking about. They're often the ones hiding in plain sight, quietly reshaping the financial landscape long before most people realize anything has changed.